Hi, I'm Candace Schultz, and I'm a financial planner here at Aspen Wealth Management. I get questions all the time about mortgages and buying a home, so I thought we would sit down today with Matt Pruitt from Sendera Funding and pick his brain. We always hear about all these different types of loans available to buy a home, but what's the difference?
So there are a myriad of different loan choices. The three most popular types of mortgage loans are conventional, FHA, and VA. And to sort of compare the three types, we could talk about down payment, whether or not there are upfront fees and what those fees look like, and mortgage insurance. Brief explanation of mortgage insurance. Basically, in your mortgage payment, there are 5 pieces. You've got principal, interest, taxes, insurance, and mortgage insurance. Basically, mortgage insurance is a way for the investor to insure their loan. If you put 20% down on a conventional loan and finance the other 80%, you probably don't even know what mortgage insurance is. However, for down payments less than 20% on conventional loans or for other loan types, oftentimes mortgage insurance will be that 5th piece of your monthly payment. So to compare VA, FHA, and conventional loans, VA, first of all, is the best loan product on the market. Head and shoulders above the rest. There's not a close second place. It's amazing. There's 0 down payment requirement. You have no mortgage insurance associated with the loan, and there is an upfront funding fee. If it's your first use of your VA eligibility, then the upfront funding fee will be 2.15%. If it's your second use or any use thereafter, it'll be 3.3%. But to compare conventional and FHA, the 2 most popular loan types for the rest of us, a conventional loan, the minimum down payment you can contribute is 3% out of pocket. That is less common to do the 3% option because if you do 3%, the mortgage insurance factor is quite a bit higher. More typically, you see 5, 10, 15, or 20%. 5% is the minimum that I usually recommend unless we're dealing with a first-time home buyer or for someone who just can't gather up that extra 2%. There is mortgage insurance until you reach 20% equity on a conventional loan. That mortgage insurance drops as you reach 5% increments on your way down to 20%. And there are no upfront fees of any kind on a conventional loan. FHA loans, you have a minimum down payment of 3.5%, and there is mortgage insurance for the life of the loan. If you put the minimum 3.5% down, you'll pay mortgage insurance for the life of the loan as of today. Those are the rules. If you put 10% down on an FHA loan, then the mortgage insurance will go away after 11 years, and the mortgage insurance factor is slightly less. There's also an upfront mortgage insurance premium, or UFMIP, of 1.75% as it relates to FHA loans. So you get an FHA loan, you've got a 1.75% UFMIP, or upfront mortgage insurance premium, that's tacked onto your loan on day one. Not that big of a deal if it's the difference between getting into a house or not. FHA loans are pretty common for first-time home buyers. Also, kind of some sub-loans that are less common under the conventional umbrella. You've got investment properties and second homes. You also can get into reverse mortgages, which if you're 62 years of age or older and you have about 50% equity in your house, then you could look at doing a reverse refinance, which leaves you with never having a mortgage payment again the rest of your life. You can also do a reverse mortgage to purchase a new home with about 50% down. Same situation, after closing you never have a mortgage payment again. Also in the list, you've got physician loans. You've got loans that are specific for doctors. That different lending institutions make available to them and other medical professionals. But at the end of the day, you really just want to get with someone who you trust and who you feel comfortable with, be open about your particular situation, and find out which loan product will serve you and your family best.